Money has always held a magnetic pull on human behavior, but there is a particular allure in the idea of acquiring it quickly. The concept of quick money taps into fundamental psychological, social, and economic instincts that have been shaped over millennia. From the earliest days of trade and barter, humans have sought opportunities that promised rapid returns with minimal effort, often because survival depended on swift access to resources. In modern society, this instinct remains, amplified by exposure to stories of overnight wealth, viral success, and instant gratification. Quick money carries the promise of immediate relief, social validation, and freedom from financial stress. Yet, the pursuit of it often comes at the cost of long-term security, disciplined planning, and sustainable growth. Understanding why people chase quick money requires an exploration of the psychological forces at play, the social pressures that reinforce the desire, and the economic structures that make instant wealth seem both accessible and desirable. Psychologically, the pursuit of quick money is deeply rooted in the brain's reward system. Humans are wired to respond to immediate rewards far more strongly than delayed ones, a phenomenon known as temporal discounting. When the brain perceives the possibility of fast financial gain, dopamine, the neurotransmitter associated with pleasure and motivation, is released, creating an intense emotional pull toward opportunities that promise rapid profit. This neurochemical response makes the idea of quick money emotionally salient, overshadowing rational assessment of risks, sustainability, and effort required. The excitement associated with potential fast gains often generates impulsive decision-making, where logical evaluation takes a back seat to emotional anticipation. The thrill of imagining instant wealth triggers the same neural pathways as gambling or high-stakes competition, explaining why quick money is not merely a financial preference, but an emotional craving. Another psychological factor is the influence of scarcity and financial pressure. When individuals feel financial stress or perceive scarcity, their cognitive resources are depleted, and the brain prioritizes immediate solutions over long-term planning. Quick money represents an attractive shortcut out of financial strain. The allure is intensified when people feel trapped in debt, low income, or unstable economic circumstances. The brain's natural response to scarcity is to seek rapid reward to alleviate immediate stress, which makes schemes promising instant returns extremely compelling. Under conditions of perceived urgency, the emotional satisfaction of potential quick gain outweighs rational caution, even when the opportunity carries high risk. This explains why people in financially precarious situations are disproportionately drawn to high-risk, high-reward ventures or speculative investments. Cultural and social influences further amplify the chase for quick money. Modern society glorifies success stories of individuals who achieved wealth seemingly overnight. From social media influencers flaunting new cars to tech entrepreneurs selling startups for millions. These narratives suggest that financial freedom can be attained almost instantaneously. The visibility of these stories creates a cognitive bias known as survivorship bias, where people focus on the rare cases of extraordinary success while ignoring the countless failures that are invisible. This cultural messaging distorts perception, making quick wealth appear more attainable than it is, and reinforcing the belief that the fastest route to financial security is also a legitimate and achievable path. Social comparison exacerbates the effect as people measure their progress against peers and visible benchmarks, creating pressure to catch up quickly. The desire for quick money is also intertwined with emotional needs beyond mere financial security. Money is a symbol of status, freedom, and competence. Quick acquisition can provide immediate validation, social recognition, and self-esteem boosts. People often chase quick money not only to pay bills but also to signal success to their social circles, or to themselves. The psychological reinforcement of rapid success can be intoxicating. It validates skill, luck, or daring, creating a feedback loop where the emotional thrill of instant gain becomes a primary motivator. This dynamic explains why even individuals with sufficient long-term wealth may still be drawn to high-risk, high-reward endeavors. The pursuit of instant gratification serves emotional as well as financial purposes. Cognitive biases play a significant role in the appeal of quick money. Optimism bias leads individuals to overestimate the probability of success and underestimate potential losses. Overconfidence can amplify the perception that one possesses unique insight, talent, or timing, making high-risk opportunities appear rational. This bias is often reinforced by anecdotal evidence of rapid wealth acquisition, ignoring statistical realities. Availability heuristics, where recent or memorable examples influence judgment, also skew perception. Seeing a peer make a fortune through a new investment or side hustle convinces observers that such outcomes are common, increasing the psychological pull toward chasing quick returns. These biases combine to create a mental environment where immediate financial gain feels not only desirable, but plausible and rational. The structural environment of modern economies also encourages the pursuit of quick money. Easy access to online trading platforms, cryptocurrency exchanges, gig economy opportunities, and speculative investments makes rapid wealth seem within reach. The proliferation of get-rich-quick content, ranging from social media advice to clickbait articles, normalizes the idea that financial success can be accelerated. Low barriers to entry for certain ventures amplify this perception as people see tangible pathways to immediate profit. The structure of financial systems and technological accessibility aligns with human psychological tendencies, making the pursuit of quick money not only tempting but socially reinforced. In this sense, the chase is both individually motivated and systemically facilitated. The pursuit of quick money is further fueled by impatience and the modern cultural obsession with instant gratification. In an age of on-demand services, rapid communication, and immediate access to information, patience is increasingly scarce. People expect fast results in all areas of life, and financial outcomes are no exception. Delayed gratification, which is essential for long-term wealth accumulation, is psychologically less appealing than instant reward, particularly when the emotional payoff of quick money seems immediate and tangible. The combination of technological immediacy and cultural messaging strengthens the cognitive pull toward rapid financial gain, often at the expense of deliberate planning and sustained effort. Psychological resilience, or the lack thereof, also influences the appeal of quick money. Individuals who have experienced repeated setbacks or failures may become more risk-prone or more willing to pursue rapid solutions as a form of escape from repeated disappointment. Quick money represents hope, a way to break free from past failures and assert control over one's financial narrative. The emotional weight of past struggles makes the allure of instant wealth more compelling, as it offers not just material relief but symbolic redemption. This psychological dynamic explains why even well-informed, capable individuals sometimes engage in high-risk financial ventures that appear irrational from an objective perspective. Moreover, social learning contributes to the chase for quick money. People model behavior based on observation of others, particularly those they perceive as successful or aspirational. When peers, mentors, or influencers achieve rapid wealth, observers internalize the belief that similar outcomes are attainable through similar means. This observational learning reinforces the desirability of immediate financial gain and reduces perceived barriers. The effect is compounded when individuals are exposed repeatedly to narratives of quick wealth through social media, advertising, or peer networks, creating an environment in which chasing rapid returns becomes normalized and psychologically reinforced. The emotional dimension of financial insecurity also plays a pivotal role. Money is deeply tied to feelings of safety, control, and self-efficacy. When individuals experience financial anxiety, the desire for quick solutions is intensified. Quick money offers a psychological relief valve, promising immediate mitigation of stress and uncertainty. The anticipation of rapid gain provides emotional comfort, even if the likelihood of success is objectively low. In this way, the pursuit of quick money functions as a coping mechanism, addressing both financial and emotional deficits simultaneously. This dual reinforcement strengthens the persistence of such behavior. Additionally, the interplay of identity and social perception magnifies the appeal of fast wealth. People often define themselves by their economic status, and rapid financial success becomes a way to assert competence, ambition, and social standing. The urgency to achieve quick results is partly driven by the need to maintain or enhance identity in the eyes of others. This social psychological pressure creates a self-reinforcing loop. The desire for recognition fuels the pursuit of rapid gain, which, in turn, validates identity and status. The complex interconnection between self-concept, social perception, and financial behavior explains why quick money remains compelling even when risks are acknowledged. Behavioral economics further illuminates the allure of rapid wealth. Concepts such as prospect theory suggest that individuals are more motivated by potential gains than potential losses, particularly in uncertain or high-stakes scenarios. Quick money offers the prospect of substantial gain in a short period, creating disproportionate psychological weight relative to slower, incremental strategies. Even when individuals understand that the probability of success is low, the potential emotional and financial payoff can dominate rational analysis, leading to decision-making that prioritizes speed over security. The psychological salience of large, immediate rewards explains why rapid wealth opportunities consistently attract attention, regardless of statistical likelihood. The cultural narrative around entrepreneurship and innovation also reinforces the chase for quick money. Stories of tech startups, viral products, and early adopters achieving enormous wealth encourage the perception that speed and opportunism are keys to success. These narratives emphasize boldness, risk-taking, and immediacy, often underplaying the years of preparation, skill development, and unseen failures that precede success. Psychologically, these stories activate aspirational motivation and the desire for social validation, creating a perception that quick financial gains are both desirable and achievable. The reinforcement of these narratives through media, celebrity culture, and social networks perpetuates the cycle of chasing rapid wealth. In addition to cultural and cognitive factors, the economic structure contributes to the chase. Volatile markets, speculative assets, and high-risk investment vehicles create conditions where rapid wealth is theoretically attainable. People are drawn to these opportunities because the payoff aligns with psychological desires for speed, recognition, and relief from scarcity. The combination of accessible technology, social reinforcement, and structural opportunities creates an environment where pursuing fast money is not only psychologically enticing but practically feasible. This alignment between cognitive tendencies and environmental affordances explains the persistent and widespread nature of the phenomenon. The intersection of emotion, cognition, and social influence explains why the pursuit of quick money is often irrational yet persistent. Individuals weigh emotional benefits more heavily than objective risk, prioritize immediate relief over long-term security, and interpret social signals as validation of potential outcomes. Cognitive biases, cultural narratives, and structural affordances converge to make quick money psychologically irresistible, even in situations where rational analysis would advise caution. Understanding these forces provides insight into both individual behavior and broader economic patterns, revealing the complex interplay between psychology and financial decision-making. Impatience, optimism, and emotional craving combine to create a potent motivational force. Individuals may recognize the low probability of success, but are nonetheless drawn by the emotional allure of rapid financial change. The anticipation of success triggers pleasure responses, reduces perceived risk, and motivates action. Over time, this pattern becomes habitual, shaping career choices, spending behavior, and investment strategies. The repeated pursuit of rapid returns, reinforced by intermittent success or social validation, solidifies a behavioral orientation toward short-term gains, often at the expense of stability and long-term growth. Risk perception is another critical psychological factor. Individuals often underestimate potential losses and overestimate personal skill, intuition, or luck. This miscalibration is reinforced by anecdotal evidence and the selective visibility of success stories. Cognitive biases such as overconfidence, optimism bias, and the illusion of control magnify the appeal of quick money. Psychologically, individuals construct narratives that justify risk-taking, framing rapid financial gain as both possible and deserved. This rationalization allows individuals to reconcile the emotional desire for speed with an ostensibly logical assessment of opportunity. The pursuit of quick money is not universally maladaptive. In some cases, it can catalyze creativity, innovation, and strategic experimentation. Entrepreneurs, investors, and professionals often leverage opportunities for rapid gain as part of a broader portfolio of strategies. However, the psychological mechanisms underlying the pursuit, emotional craving, cognitive bias, social pressure often dominate, leading many individuals to engage in speculative or impulsive behaviors without adequate preparation. The difference lies in awareness, emotional regulation, and the integration of quick money pursuits into a balanced and informed strategy. Ultimately, the psychology behind chasing quick money is a complex interplay of neurochemical reward systems, cognitive biases, emotional needs, social influence, and structural opportunity. Humans are wired to respond to immediate rewards, reinforced by cultural narratives and technological accessibility. Financial scarcity, identity concerns, and social comparison amplify the effect, creating a powerful motivational pull toward rapid gain. While the pursuit can occasionally yield success, it is frequently accompanied by risk, stress, and long-term instability. Understanding these psychological drivers is crucial for fostering awareness, developing self-regulation, and designing financial strategies that balance the allure of immediate reward with the security and growth of long-term planning. Breaking the cycle of chasing quick money requires conscious intervention. Emotional awareness, cognitive reframing, patience cultivation, and social support are essential. Individuals must recognize the seductive pull of instant wealth, distinguish it from strategic opportunity, and calibrate actions according to both risk and long-term goals. Financial literacy, delayed gratification, and resilience building help mitigate impulsive tendencies, enabling a more sustainable approach to wealth accumulation. By understanding the psychological mechanisms behind the desire for rapid gain, individuals can transform instinctive reactions into informed decisions, reducing vulnerability to exploitation, speculative losses, and behavioral pitfalls. In conclusion, the pursuit of quick money is not merely a reflection of greed or laziness. It is rooted in deeply human psychological mechanisms. The brain's reward system, Cognitive biases, emotional needs, social pressures, and cultural narratives converge to make rapid financial gain compelling. While the allure is powerful and persistent, understanding its underlying psychology provides insight into behavior and offers pathways for more deliberate, informed, and sustainable financial strategies. Awareness, education, and emotional regulation can transform the instinct to chase quick money into a conscious tool for opportunity, rather than a source of repeated frustration and risk. The psychology of quick money reveals as much about human desire, perception, and cognition as it does about economics, illustrating the profound interplay between mind, society, and financial behavior.